you wondering how to buy a house in Canada? Specifically, how to buy a house here in Ontario and within the Toronto GTA real estate market? If you're a first-time homebuyer or it's been a while since you last invested in real estate, this episode is for you. If you've ever asked, how much money do I need to buy a home, or can I buy a home with no money down? If you're curious about your home buying power and the cost of buying a home, if you're wondering if there are any programs available to help you get in the real estate market, well, if you've answered yes to any of these questions, then you'll want to listen in on my conversation with mortgage specialist Christine Baumer. Today, we'll cover the entire home buying process in Canada, from deposits to down payments, and the difference between mortgage pre-approvals and mortgage approvals. Is there a difference? We'll also explain how your credit score impacts your ability to buy a home, what type of credit score you need, and how to maintain and increase the credit score you currently have. Then there's the stress test. And if you're wondering about the stress test, mortgage insurance, including what it is, who needs it, and how much it costs, we have you covered. If you're a first-time homebuyer or know someone who is looking to get into the market, if you've been out of the market for a few years and are looking to purchase real estate, or if you are just curious and want to be in the know, join us as we share tips and mortgage advice on the home buying process. You are in the right place. And stay tuned to learn how to get your free copy of the Home Buyer's Guide. And without further ado, I would like to introduce to you our special guest, Christine Baumer, mortgage specialist with RBC. Good morning, Christine, and welcome.
Well, thank you. Thank you for inviting me, Evelyn. I'm excited about today.
Well, before we jump in, can you maybe share a little bit about yourself with our viewers?
Certainly. So I have been working with RBC as a mortgage specialist entirely for the past 10 years. Prior to that, I worked as a financial advisor. So part of our role, or part of my role with RBC, is simply doing mortgages, but I like to look at the holistic picture for our clients so that we're putting them into a good position, not just for the mortgage, but for everything that goes along with it, all of their finances.
That's great. So when an individual is considering buying a home, one of the first things that they should be doing is getting their finances in order to find out how much of a mortgage they would qualify for and just getting all their ducks in a row. So what is this process called, and why is it so important, and how does it benefit the consumer?
Okay, so yes, there's two different approaches that we take, two different steps in all honesty. So if a person is just thinking about getting into the market and starting to maybe not go out and look at houses, but really planning for their future, we like to sit down and do a pre-qualification. So that pre-qualifying a client will just let them know exactly where they should shoot for, based on their incomes, as well as what they think that they can save for the down payment. We also take a look at the credit bureau. It's a really quick process, like a 5-minute calculator that we can do. Pull the credit bureau and say, okay, here's a little bruise on your credit. Take a look at that. Let's see if we can get that under control. So really, it just gives them knowledge for when they are serious about looking. Then the second step would be a pre-approval. That is when they know they have their down payment, or they're pretty close to getting their down payment. They want to start going out and looking at houses with a realtor. This gives them a concrete idea of what they can afford, what they need to have for a down payment, what they can afford, what their payments would look like, and just kind of gives them peace of mind, as well as the realtor and the sellers, because they know that the people they're showing their home to have a serious interest.
And ability to buy, which is fantastic. Yes. So before we get into it a little bit more, there are a lot of words that are used within the financial industry. And sometimes I find that buyers get confused with what these different terms mean. So if we can take a moment and maybe just go through some of the basic terms that they're going to hear, starting with mortgage. What is a mortgage?
Well, a mortgage is simply the amount of money that we are going to give you to purchase that home. So that's essentially it, what the lender gives the client in order to purchase the home.
And what is an interest rate?
The interest rate would be the cost that you are paying the lender for that mortgage.
Okay. Now, this is one that I see a lot of people getting confused, even people who've bought and sold. And that's the difference between a down payment and a deposit.
Absolutely. So a down payment is your contribution for the purchase of that house. So if you're purchasing a home for 900,000 and you're putting 90,000 as a down payment, that's your savings. That's what you've worked for to put towards this house. RBC is giving you the mortgage. So the down payment is that portion that you're contributing. The deposit is what is required for a purchase agreement to go in. So if you're making a purchase offer with your realtor, the seller will require a deposit. And that deposit is really your commitment that signifies you are serious about buying this home. So that deposit goes to the realtor and they put it in trust. When the home goes through, if the home goes through and you do purchase it, it will come right off that down payment. So it does balance out. It's not like it's in addition, it is part of that down payment.
Right. So if you had, like in your example, $90,000 saved up for a down payment and you put 20,000 as a deposit, on closing, the balance amount of money you would have to come up with as a buyer would be the 70. So 70 plus 20 is your total down payment of 90. Okay. Another term that we often hear when we're talking about mortgages is conventional mortgages and high ratio mortgages. What is the difference between those two mortgages?
So a conventional mortgage is if you have 20% or more for the down payment, we would put you into a conventional mortgage. If you have any less than 20%, the government mandates that you have to have default insurance. Now that insurance does protect the lender. However, it also allows you to get into the market with as little as 5% down. So if you put 5% down, we will arrange with a default insurer to put insurance on that property. We take that insurance and you have the option of paying it outright, which I don't often see, but we typically will put it into the mortgage and you will pay monthly payments on that with your mortgage balance.
So you don't have to have that money up front. It'll be
Correct, yeah.
okay. And you mentioned buying with as little as 5% down. So is 5% down, and this is a misconception too, only for first time buyers, or can somebody who has previously bought a home go out and buy another home that is with 5% down?
Absolutely. Yes, you can. Now, you can't do that for investment properties or cottages, but you can certainly, if it's your primary residence and you have sold your home, you're going into another, you can certainly do it with 5% down. Yes.
Okay, thank you for clarifying that. Another term that we often hear is amortization period and the term of a mortgage.
Okay, so amortization is so if you have that $900,000 mortgage, we're going to calculate it over 30 years. Figure out your payments based on a 30-year schedule or 25-year. It's entirely up to you as well. Well, what you can afford, right? Within 25 or within 30. 25 is typically the spot that people land. 30 years will reduce your payments. So that's the amortization, the length of time that it will take you to pay that mortgage off. The term it's the contract that you're making with your lender. So I will take that term of 5 years at this interest rate, or at 3 years, whatever you choose, or whatever is right when you sit down with your mortgage specialist. And then in 3 years or 5 years, whichever term you've chosen, you will come in and renegotiate with your lender.
At whatever the current rate is at that time. Okay.
Yes, yes.
So when we're talking about amortization periods, you mentioned you can go as long as 30-year AM. You said 25. I know there's like 15, there's 10. How does the amortization period affect a buyer's payments?
Oh, it can affect them substantially, right? So first of all, we're going to take a look at their numbers and see what works, right? So if their payments are too high to get approved for a 25-year amortization, we'll extend it out to 30 years. However, there's several clients that can pay their mortgage off in 20 years or 15 years. So the numbers have to work, but it's ultimately the client's decision if the numbers fall in line. So, but it does substantially affect that payment.
Right. So the longer the amortization, so 30 years, for example, the lower the payments, the shorter the amortization, the faster you're paying off the mortgage, but the higher your payments are because you're paying it off faster. You're still borrowing the same amount of money, but you're paying it back over, different time period. And currently, what is the longest amortization period that is available to buyers?
So right now it's a 10-year term with RBC. You can go up as high as 10 years. I don't often see people going to 10 years. I mean, there's a security in knowing what your payment will be over a 10-year period, but they're also higher interest rates, right? So I don't typically see people going 10 years, but it is out there. It is an option. 5, 7, 10.
Right. Okay, so when someone buys a home, they have to put in a down payment. We talked about the down payment comes from their savings. But I've also had people come and approach me asking, well, I've heard that I can buy with no money down. Can an individual buy a home in Canada with no money down?
So I don't believe so. I believe I've seen those slogans out there and buy with no money down. I don't believe that's a true. I believe it's a little bit. There may be a loan attached in there, so it's not. You're not really getting it with no money down. Now, RBC doesn't do this kind of lending, so I can't really speak on it. But I do know that you do have to. It's mandatory that you have a down payment for a home, minimum 5%. So I think there may be like a hidden, like a loan in there somewhere, not hidden by any means, but a loan in there somewhere. The only other option I think is if clients own a home currently and they have a conventional mortgage and they want to withdraw some of their equity from that home to use for another purchase, then you're drawing your equity, putting it as a down payment on another home, but still it is a down payment.
Right. So, yeah, I find it's a little funny when people ask me that question, buying with no money down, because you need money to have a deposit on a house when you submit an offer. So, and I think
Even for
any
the
lend,
deposit.
right. And I think any lender is going to want some of your own skin in the deal, right?
Yeah,
So,
absolutely.
yeah, I could see if it's like you said, if it's they're taking equity from their home, it feels like there's no money, but there is still money that's coming from another source. But okay, yeah, it's definitely nothing that is traditional that I'm aware of. Yeah, it's a little funny when I hear that. So let's move on to the differences between a high ratio mortgage and a conventional mortgage. What's the difference, and how do these two different types of mortgages impact consumers?
Certainly. So if you're able to put 20% down on your convention, we would put you into a conventional mortgage. So 20% down, you do not need to go into high ratio. It's conventional. If you put less than 20% down, you're going to be in a high ratio mortgage, and it's mandatory that you pay for default insurance. So that default insurance, it does cost the consumer. We add it on to the life of the mortgage if you choose that method. You're paying it monthly with your mortgage payment. It does protect the lender from default. However, it does allow the client to get into the market with only 5% down. So it is a huge benefit to somebody who is struggling to save, that 20%. The 20% can be daunting. So
Absolutely, especially here in the Toronto GTA, where the price of homes is quite substantial. To just even say 5% is can be daunting for people.
yeah, and hopefully over the couple of years that you're in early, that equity will grow and you won't even notice that CMHC so much or the default insurance.
Right. And so the default insurance, does the consumer need to come up with that money at the time that they're getting the mortgage, or is it built into the mortgage?
Yes, it's absolutely built into the mortgage, so you can pay it monthly with your mortgage payments.
Okay, so that makes it a little bit more affordable as well. So, moving on to government programs, there are numerous government programs and incentives available for especially first time buyers to get into the market. Maybe you can highlight some of those that are.
I can touch on those a little bit. So, the government allows you to use your RSPs, a portion of your RSPs, for a down payment. They've also started, and you use those RSPs, you can withdraw them. You will not have the tax implications at the withdrawal, provided you put them back in over, I believe it's 15 years. You pay it back to your, it's almost like paying yourself back. They've also come up with the first home buyers account, which is very similar to putting into an RSP. You get some tax benefit there. When you pull out the money, you do not get taxed on it, and you don't have to put it back into your RSP. So that's a relatively new account. There's limits of $8,000 per year that you can put on there, up to 40,000. But I would advise, if you want to discuss that further, connect with me, and I can connect you with one of our investment specialists that can give you the info on that, because I'm not licensed.
Right. And some of the other ones as well is the first time buyer land transfer tax rebate. So I think the whole takeaway is that there are different programs. Some municipalities also have programs for first time buyers. So there are programs that are available. The key is to find out what programs are available and applicable to you, right? So that's when you would connect with your lender or your realtor, and they can go over the programs that you are qualified for and make sure that you use those benefits, because especially the first time buyer benefits, you're only a first time buyer once, so you definitely don't want to miss out on any of the options that are available to you. And I know RBC has additional programs to help all kinds of buyers get into the market. Maybe you can touch on some of those.
Yeah, so we really have some strong policies when it comes to self-employed clients, wealth accumulator, newcomer to Canada, even medical students or residences. Like for the stated income, for instance, we understand that people keep, business success. You want to keep as much income and cash flow in your business as you can. When we do a file, we're supposed to look at the net income for a self-employed, but our unique policies allow us to go beyond that. We take a look at your gross, your business financials, and we can build a business case, which allows us to go higher on that. Wealth accumulator, we have a lot of people that are maybe retired and want to downsize, but they don't have income to support a mortgage. We can do a combination of a lower income with their proceeds of sale and maybe some investment. So we've got a lot of opportunity there. So there's all kinds of programs in different scenarios. Newcomer to Canada, we can look at a thin bureau and maybe not the long job tenure, so we can take a look at those things. There's so many policies out there that we can go over. So it's really important. Knowledge is key, right? So if you're in one of those unique scenarios, I think it's really important for you to connect, and we can certainly look at what would suit you best, right?
Okay, great. And do you have any specific advice for someone who is self-employed or who has irregular income?
Yeah, so self-employed, I have several clients that have called me and said, I'm with this lender at a higher interest rate because my income was low, self-employed. They need to just reach out. They really need to connect with a mortgage specialist and see if we can help them, because, if they've got a successful business, it makes sense to look at the big picture and review everything. I think there's maybe years ago, people weren't aware of all of these policies, so they started going to different types of lenders, and I think we can really start to look at that. So maybe get you into a better position, right? Irregular income, that's one thing where we have a lot of clients that may be a nurse that works part-time here and part-time there. We may need a letter of employment or substitute teacher. We need some guaranteed hours. So that's really important for them to come early, get everything ahead of time, so that when you're down to that 5 days closing of conditions in 5 days for financing, we're ahead of the game, and your employer can provide what we need if you don't have access to it.
Right. So being prepared is definitely key, because as you mentioned, typically when you put an offer in to purchase a home, it is conditional on a financing, and usually you're only given 5 banking days to do that. So part of that is going to be for the bank to do their due diligence. And if it's a conventional mortgage, they can do it, I believe, in-house. If it's a high ratio, it has to go to an underwriter with CMHC or Genworth, and that takes time. And it's a little bit beyond your control because it's not at the bank level. But in order to complete that file, my understanding is you need to have that documentation that's required. And sometimes that's where the holdup comes, right? Someone needs to get a letter of employment or copies of their bank statements or, copies of their income that's coming in. And that's the holdup, right? So if you're asking your boss, I need a letter to say that I work here and how much. And it says, well, it has to go to our HR. And they're like, okay, I've got this backlog. You'll get it in a couple of days. Well, that couple of days is eating away at
It's
your
valuable
5 day.
time, and it's stressful time for clients when they're waiting on that 5 day condition. I know it's stressful when they put the offer in and they're waiting for that acceptance, but the more we can get ahead of these things, the more you'll appreciate the process. So
Right. And part of that 5 day condition, when the bank is doing their approval, they are doing the appraisal at the time of the application, or do they wait until closing? And I know that has led to some problems, especially when there's shifts in the market.
yeah, no. RBC try before we give a firm approval, we have all of our underwriting completed. We have the appraisal completed, and we do it. We try to get it done within 5 days. Now, there are times in this real estate market that appraisers can't get out there in time. So what we do is we say we can give you an agreement in principle, which means from financial, all of these items are ticked off. Once the appraiser comes back, then we can give you the firm approval. So very rarely do I see that extend past 5 business days, but it has happened, and it's just a time in the market. But RBC does our appraisals as soon as possible. I know other lenders, or some lenders that I've heard of, will wait until a week or 2 weeks before closing. That will never happen with us. We will always get it done, as soon as we can. We order it the day that we get the purchase agreement.
Right. And that's really something that buyers should be aware of, because what you don't know, you don't know. But it really gives you that peace of mind to know that everything is approved and you're good to go. And I know that RBC also has some, I guess, unique programs or a unique policy in terms of being approved and
Approved, fully
totally
approved.
approved. Yeah. Do you want to
Yes.
speak to that?
So one thing that we really stand out on is when we approve you for a mortgage, you are fully approved. We know things can happen in life, but these longer closings, if it's 120 days or even a new bill that's out 2 years, if we've approved you, we will never renege on that. So people can be faced with unexpected layoffs. COVID, I know, knocked people around a bit, but we still closed on all of our deals. And the reason we do that is we know it's a domino effect, and we know we're approving you based on that day, and we want to stand behind our commitment. So
Perfect. And so when they are applying for a mortgage, what types of documents typically does a borrower need to provide?
typically, we are looking for their down payment. So we need a 3 month history of their down payment. So if their savings are within RBC, I can just pull that up. So it's not really too big of a deal. They may need a gift letter if they're using gifted funds from a parent or from a relative. So that's the down payment. We need to confirm that. We need to confirm their income. And this is where things get vary. So it's very different. If you have a salary and a regular paycheck, we may need only one T4 and a pay stub. However, that's rare. Most people have some form of bonus or some form of overtime or different variances throughout their income. So I would ask for 2 years of T4s and a pay stub. Then when it comes to self-employed, it's different again, right? We need 2 years of their income statements, their T1 generals and notice of assessment. So it gets very different. And then those specialized programs, again, we look at deeper things, business financials. But all of that is very easy to go through with a client. It's just a lot to hear when there's so many different scenarios.
Okay. And so when the lender takes all of these documents and they are looking to make a judgment on their approval, what are some of the key factors that lenders consider?
Okay, so one of the most important things, or two of the most important things, your credit history, because we want to see the type of repayment structure that you've had in the past. The other thing is we do a ratio, a total debt servicing ratio and a gross debt servicing ratio. Those numbers give us a really solid guidance into what you can afford. And they are regulated by the government on what we can give. So for gross debt servicing, that is just your housing expenses. We want to have your mortgage payment, your property tax, and your heat. We divide that by your income, gross income, and we come out with a number. That number, we'd like to see it under 32% for the gross debt servicing ratios. For the total debt servicing ratio, that would be those three numbers, like your mortgage, your heat, and your property tax. And in addition, any other debt that you have out there, credit cards, loan payments, all of it. So we want to see that number below between 40 to 42%. We can go a little bit higher if we can build a business case and explain how you are going to be able to make this work, right? So if you've got a lot of savings behind you or you have a lot of fluctuating income, then we can always build a case around that or try to build a case around that, right?
Okay, so one of the things then is your GDS and your TDS. What else does the lender look at?
Look at the credit history. We want to see that you've got strong credit history. If you don't, then we need to build a case and explain why. And it's not, it's not that difficult to explain. If you were in your 19 years old and you had a credit card and you abused it, and 4 or 5 years later everything's good, it's understandable that there's hiccups in the past, right? So as long as we know what we're getting into and we can explain it, we're in a pretty solid position, I think. So we look at those two things. We also look at the down payment, whether it's savings or investments or gifted funds. We need to have a history of that. Even if it is gifted funds, we need to confirm where those gifted funds came from, right? So a 3-month history there as well.
So another big topic is the stress test. And people are always asking, what is this stress test? And how does this mortgage stress test work? And how does it impact me as a buyer?
Yeah. So what the stress test, they came out with the stress test a few years ago, and it's government mandated that we follow it. We used to always follow it for anything less than 5-year fixed term. Now we follow it for all of our mortgages. That stress test is if you're given an interest rate for your term. So let's say you're getting a 5.04% interest rate. We are going to qualify you at 7.04. So we make the payments out for you so that you're paying at 5.04, but we add in the background, I guess, and qualify you as if it was at 7.04. That way, we know that if your mortgage comes up for maturity in 5 years and rates are 7.04, you should still be able to afford that mortgage. We've seen that recently with clients that have very low interest rates. We did the stress test and we added 2%. We added 2%, but I actually think it was to a minimum of 5.25 back then. So that meant if your 2% mortgage rate came open, we qualified you at 5.25. So you should be able to handle that mortgage. So it's frustrating because you feel like, oh, I can afford so much more. But honestly, it does protect the consumer because you want to make sure you can handle your home when interest rates open.
Then we're talking about credit scores. So you mentioned bruised credit scores, and there are things that you can do to improve your credit score, and there are definitely some things that you should not do, especially once you've purchased a home and you're waiting now to close on that home. So maybe you can speak to some of the things you can do to improve your credit score and some of the things you should not do once you've been approved for your mortgage, waiting to close on the deal.
Okay, so I think just as with anything that we're talking about, I think knowledge is important. You can go on to your online banking. With RBC, you can. I'm confident you can with other lenders as well. But you can go on and pull up your credit bureau, and it's considered a soft hit. So you can look and see what's on there, knowing what's on there. If there's any mistakes, if there's anything that you're going to need to address, get it done. If there's a little missed payment there and it continues to show, find out what that payment is, pay it. Get it out of the way. So just being aware, keeping your credit scores or credit cards lower if you can, keep them as low as possible. Also, never ever go over your credit limit, the banks will allow you to do it, or the credit card companies will allow you to go over $10, $15, and you may think it's not a big deal, but it is very damaging to the credit bureau. So just watch that. The other thing I would say is if you're getting pre-approved for a mortgage, so with the pre-approval, it's not yet firmed, right? Like we're going to look at your credit history again. So you don't want to go out and run your credit cards up once you've got that pre-approval and make a lot of purchases. Even with the firm approval, once you get a firm approval from RBC, as I said, it is firm. We're not going to renege on that. However, it is in your best interest to not go out and put a lot of things on your credit cards because we qualified you at that point, and you don't want to all of a sudden get in your house and go, well, I can't afford this because now I've got a new car and now I've got $10,000 on credit card appliances. So you want to take care of yourself. So if you're going to do those things, I would talk to your lender and say, I'm intending to do this. Maybe put it into the picture and we'll show you, yes, this is how much you can afford if you don't do that. And this is how much you can afford if you do. So just conversations, right?
Right. And I think one thing people do too is they buy furniture and then, or appliances, and the retailer says, oh, well, you don't have to pay for a year. And they think, oh, well, it's good. I don't have to pay for a year. I'm expecting to get an inheritance or whatever it is, win the lottery. And they think it doesn't affect them. But even if you buy something and you're not starting your payments for a year, that still shows up on your credit bureau, correct?
So yeah, if you run your credit cards up, we do look at that. Even if they're saying it's zero payment, we are calculating a payment, right? So if you put 7,000 on there, we're going to calculate. I believe it would be about. I believe it would be about $210 a month on there for 7,000, and it will go up whatever you're putting on there. So it does affect you. It does affect you. So just be cautious. Even if we do say, well, we're still going to close on that mortgage, it's going to affect you when you're living in that home. So just be cautious. And furniture never fits the way you want it to unless you're in the house anyway. Wait to buy the furniture.
One of the things that obviously consumers do when they're looking to get a mortgage is they shop interest rates. And I always say that that's an important component, but it's not the end all and be all. So maybe you can talk about, what are some of the things that you should look for in a mortgage, and a little bit about interest rates and what they see posted.
Yeah, absolutely. Well, I will say that RBC, we are always competitive, right? We're always competitive. You may be able to find a cheaper rate out there. Doesn't necessarily mean you're going to be in a better position. And that's what we want to do is we want to put you into a better position as a client. So some of those cheaper rates may come with other costs involved, right? For the appraisal, for renewal, for re-signing, all of these things. So it's really important. Yes, rate is definitely important, but it's also important to be aware of what you can be offered, right? You want to sit down with our team. So I, as a mortgage specialist, all I do is mortgages. So I really specialize in mortgages. So I want to win your business. I don't want to get your business. I want to win your business and then introduce you to my colleagues who will be with you along the way. So particularly for first-time home buyers, I really think it's important that I sit down with you and I include one of our financial advisors or our banking advisors who can take a look at the big picture and get you into the right product, the right term, the right interest rate. So advice is a huge factor with RBC that we really want to emphasize. So it's not always about rate, although we are very competitive. We always seem to have some offers going on. So that's open for a discussion as well. Like sometimes there's cash incentives, Avion points that will get you a flight across North America. Those come on here and there. So there's other things other than rate that should drive you. Rate is extremely important, and we know that. So we are very competitive. But yeah, there's a whole package there. We like to get you in front of a financial advisor so that as you're paying down your mortgage, you can also be saving for your future, for your investments. RBC does offer double up payments, skip a payment, 10% lump sum payments. So there's a whole gamut of things that you can look at. It's not comparing it. You want to compare apples to apples is what I'm.
Because I always say too, the interest rate's important, but you should look at some other things. So one of those is prepayment privileges. Does the bank or the institution allow you to pay down some extra money without being penalized? So sometimes, you get a tax refund or you work some extra overtime and you've got this little extra money. So you can, save it, or you can buy stuff, or you can put it towards paying down your mortgage faster, because the more money you put down on the mortgage, the faster it pays off, the less interest that you're paying over the long term, so the less it's costing you. So you said that RBC has a 10% prepayment privilege annually?
So you can pay down your mortgage in three different ways. So one is a 10% prepayment of the original lump sum balance per year. So if you come in and you've got a $600,000 mortgage, and each year you can put $60,000 on it for that term. On top of that, you can increase your mortgage payment by 10% once each year. And then my favorite one is the double up payments. Now, the double up payments are a minimum of $100 up to double the principal and interest. So let's say your mortgage payment is $2,200 a month. You can increase it to $2,300, and that $100 just comes directly off principal. Or you can increase it to $4,400. $2,200 comes completely off. You can do that every single payment, or you can start it and stop it. You can do it once. The reason I really like that is because I have a lot of younger clients that will come in and I'll say, okay, first time home buyer, we go through this, and I always say, give it 6 months, give it a year, and get some savings behind you, and then take that $100 double up payment and increase your payment by $100 each month, or each pay period. And then once you get used to that, increase it another 100. And they get so it really helps younger clients that are like, this is a long-term mortgage. So it can really knock down substantial amount on your
Okay.
principal.
Another thing I find is that most lenders will say that they want their payments, their monthly payment for the mortgage, once a month. And I always suggest to my clients that if you can pay weekly or weekly accelerated. So, let's just say I'm going to use easier numbers for my math. Say your mortgage payment was $1,000. So you would pay $1,000 every month, or if it's bi-weekly, it would be roughly half of that, $500 every month. Or if it was weekly, it would be $125 plus or minus a couple of bucks every week. So the more you pay, the more often you pay, I should say, the faster you're paying down your mortgage. And if you can do weekly accelerated, which is, I think there's 3 months in the year that have 5 weeks. Is it three? There's that little saying. So if you can do weekly accelerated, then every single week of the year, you're going to pay a part of your mortgage.
Right.
Does RBC have that program?
Oh yeah, absolutely. We encourage it. So what happens is two full payments will come off your principal per year. So you would take off about 2.5 to 3 years from your amortization, which is huge.
And it's
It's
really
huge.
without
So
any additional savings. It's just a matter of taking that mortgage payment and dividing it up. Like I said, it's only a couple of dollars difference here or there. So it's a great way to pay it off without having any additional savings. But in addition to that, you can still use your 10% prepayment privilege, your double up payment, and every little bit, will help pay down that mortgage faster. Because a lot of people say, oh my God, my amortization is 25 years or 30 years, 25 years, 15 years, I'm going to be paying this mortgage. And you just kind of want to get it out of the way. So that's one way that you can do it. That really is no extra money. And like you said, it's 2 months.
right. And you'll be so pleased. You'll be so pleased seeing that number come down, because that's the other thing is it's on your online banking. Your mortgage is right there in front of you. You're not waiting for a statement at the end of the year to go, okay, what did I pay and it's right there. So it becomes like a little challenge, right? Like, let's knock this down. So
We've covered a lot in this morning's conversation. Thank you so much for sharing all that valuable knowledge. One of the other questions that I have are the costs that are involved in purchasing a home, especially in terms of getting your your mortgage in place and some of the other incidentals that you need to budget for in addition to that down payment that you saved up. What are some of the other costs that buyers should be aware of?
So one thing, we land transfer tax. It's very important, and it's costly. So we'll do a calculation and determine the approximate amount that the land transfer tax will be. Your lawyer will figure that out completely, but we have calculators that will figure that out. We also look at lawyers fees. So if it's just a purchase, I would say 2,500 should be around the sweet spot for a lawyer. Although it's an individual lawyers determine that. And the other thing is RBC always charges called a processing fee. With every mortgage that we do an appraisal, whether it be a full appraisal, a drive-by appraisal, an online appraisal. There is an appraisal done. So that fee we cover the appraisal with as well. So there's your fees. That's pretty much it. Unless you want to calculate in all of your incidentals, which we don't actually calculate, but you just want to watch for your moving fees and your utilities.
And also, in regards to the land transfer tax, you want to be aware of whether or not you qualify for any rebates. So if you are a first-time buyer, there are rebates available. So if you're buying real estate within the province of Ontario, there's a land transfer tax. And that land transfer tax is really calculated based on the purchase price of the property. And as a first-time buyer in the province of Ontario, you can get a land transfer tax rebate of up to $4,000. Now, if you're buying within the city of Toronto, they have their own land transfer tax. So we call it a double cohort, and it's roughly about the same amount. And if you're buying in the city of Toronto and you're a first time buyer, they also have a rebate of up to $4,750. So you want to make sure, again, getting back to our initial part of our conversation, is what are the programs that are available? Make sure you access those programs and they can help with everything that's involved in purchasing. So as we bring our conversation to a close, I'm going to ask you if you could share what a common mistake that first-time home buyers, or actually any home buyer, makes during the mortgage process.
So I would say first-time home buyers, but actually any buyer, it would be preparation, right? We are always, realtors will send us the documents, the appraisal will send us the appraisal report. Documentation is so important to get ahead of. Like I said, if you have a part-time job or fluctuating income, you want to get ahead of those letter of employments, all of those things. 5 days is usually the spot that we try to get our financing all done for. And if we're waiting for 2 or 3 days for documentation, that's a tough one. So the sooner you can get your documentation to your mortgage specialist, the better off you'll be. It's the most stressful time I think there is. Everybody loves going and looking at houses, but the mortgage is not as much fun, apparently. But we try to make it fun. So just preparation and knowledge of what you need. So get in ahead of time, and I think it will be a much smoother process for everyone.
Great. Well, thank you for that. And if our listeners have questions or would like to get in touch with you, Christine, what's the best way for them to do that?
Yeah, so you can certainly email me at christine.bomber@rbc.com. You can also send me a text or a call me directly, and my cell phone number is 226-820-5076. I'm available most of the time. Like if you send me a text, I will get back to you as soon as possible. And I work Sundays as well. So you don't have to wait until Monday morning, banker hours, to get in touch with me, because I'd love to have a conversation. So.
And there's no cost or obligation with that reach out.
Oh goodness, no. There's no fee. And if it's something that I can't help you with, like if you're looking at where do I invest my money while I save for this house, or I can certainly set you up with one of my colleagues to do the investing or put you into the right package, right?
And that's, as you said earlier, it's the information that is priceless. But I always say it's not only the information, I say it's the interpretation of that information, because everybody it affects everybody differently. So what is the information? how does it impact me and what's my next best move? And so if you're wanting to find out what your next best move is in terms of mortgages, please do reach out to Christine. I will put all of your contact information in the show notes so that get the spelling of your name and everything correctly. Thank you so much for joining us this morning. This was a great conversation.
Thank you. Thank you. I hope I helped. I hope I offered something, but I think knowledge is the best point here. So
yeah, and I think we definitely covered a lot of ground. And so I think it's a good foundation for anybody who's looking to buy their first home. Maybe they've been, like I said, been out of the market for quite some time. They're looking to get into the real estate market, or they know somebody who is looking to do that. And this is valuable information. So even if you know of someone who's looking to get into the market, whether it's your kids or your neighbors, again, Christine would be more than happy to speak with them.
Absolutely. Thank you so much.
Thank you.